when Jonathan McMillan, um, and the pseudonym for two economist banker people came out with their book, 2014, The End of Banking. I read it, and it was my first real take into what the Federal Reserve today calls non-bank money. And and I was able to then go into this book, uh, uh, Michigan, and Michigan talks about, it has in this book a wonderful story about money market mutual funds and how in the 1970s they had to get around Q, a 5% interest rate, when the interest rates were much higher then. And so the banks didn't want to lose their customers, so they wanted to keep them in the bank, and so they wanted to come up with a new system to give them a higher interest rates that could get around Q and money market mutual funds. And so that conversation is in this book. Michigan is a Federal Reserve governor during the first 2006 to 9, right during that crisis. But he's also done these written university books for our situation, for understanding money and banking in the financial markets. And having gone through that crisis and having been an author, this is his like ninth edition that he's written. I just want to read this as a preface. And yeah, if people can let people in, that would be great. When I took leave from Columbia University in September 2006 to take a position as a member governor, and this is an author. I got a book on a pre-sale, and he's just writing us a note that he's printed right into the book cover. So I'm not sure if this went out to the general public or not. But so in September 2006, to take a position as a member governor of the Board of Governors at the Federal Reserve System, I never imagined how exciting and stressful the job was likely to be. The Fed was going through major changes as the new chairman, Ben Bernanke, settled in. At the same time, the economy was hit by a perfect storm of formidable shocks. The more than doubling of prices for oil and other commodities, which led to high inflation, and the onset of the subprime financial crisis in August 2007. The resulting contraction in the U.S. economy reverberated throughout the rest of the world. When I returned to Columbia in September 2008, the subprime financial crisis had reached a particularly virulent stage, with credit markets completely frozen and some of our largest financial institutions in very deep trouble. The subprime crisis, the worst financial crisis the world has experienced since the Great Depression, has completely changed the nature of money, banking, and financial markets. The field of money and banking will never be the same, making all previously published money and banking textbooks obsolete, including my own. The bad news is that this required me to completely rewrite the large portions of this textbook, which has indeed been a challenge. The good news is that the money and banking field has never been as much fun to teach or as intriguing to study. Then he writes, just as the last thing, the ninth edition, this is the ninth, of The Economics of Money, Banking, and Financial Markets is the most extensive and exciting revision I've ever done. I hope that students reading this book will have as much satisfaction learning from it as I had in writing it. Frederick, Michigan, April 2009. And I've gone through this book quite thoroughly. I've shared it many times. I've worked with Zarlanga on this, thinking about this book too, and he still has it. he's still in the old system of fractional reserve banking, basically, and it takes a while to leave that, but it's not quite where we are today. And by 2011, the Fed was even working internally, knowing the situation had changed deeply. And they were beginning to share that knowledge with some other people, it seemed. Anyhow, so it's interesting times. So in understanding these times and understanding um, the shadow banking system, this is a strong accounting book and to understand it. And so the nuts and the work in this accounting book was crucial. I'm just going to admit, Tom, and so this was an eye opener for me, and it's something I went through and took a lot of notes and went through it, and so I really could absorb it. And then it helped me go to other sources to dig a little bit further. And then lo and behold, earlier this year, along came Capitalism and the Market Economy, again, written by Jonathan McMillan. And the bottom line is bringing back together what banking pulls apart. Now, what's interesting? Let me connect these two books really quickly for a moment. Where this is Zarlenga's book and this book, and so how do we? In Zarlenga's book, it's a history. It's a deep history of seigniorage, and how did and he was and Zarlenga was very strong into the gold market futures originally before he got into monetary thinking and reform. And then so this is a history, and it's a very vibrant history because he's able to very comfortably talk about the amount of gold or silver in coins and how they can be that amount can change in but the value of the coin still may have a different value, a face value. And so he's very strong in that, and then having a wonderful conversation coming through history. Capitalism and the Market Economy is a wonderful book. It's a very straightforward, very readable, and the history it primarily starts with is the central banking system at the Bank of England and coming up in time. And so this is like a foundation piece for us to build up and look at our present system, not so much as Zarlenga did historically, but to look at accounting in a very simple way and to look at where we are and with a very strong focus on the money system. We're not talking about all of capitalism and everything else. This is a concentration on changing the banking system. And Howard's song that we heard before the start really fit into this book well, because it deals with money and thinking about money. So today we have a most wonderful presentation from Jonathan McMillan, one of the two co-authors, and a very special person. And I've had some correspondence with Jonathan, and it's been delightful. And I want to bring Jonathan up here if we can. Jonathan, can you hear me?
I can hear you very well. Can you hear me as well, Stephen?
Yes, I can, Jonathan. And Jonathan,
Perfect.
were you able to hear that song a little bit by chance?
Yes, yes, I liked it. It was really nice. I tuned in like 10 to 4, so I heard the song, the introduction, and yeah, I'm really excited to be here today. And thanks a lot for the invitation, Stephen. And good morning, everyone. I know you're in the US and you just woke up and had your coffee. Um, on my country, it's already 4 p.m. So I'm joining you from Switzerland, from Zurich. And
Jonathan, let me say one thing about you so people know how to start thinking and asking questions later. Jonathan has deep knowledge about the present banking system. And and strong familiarity with it in New York, in London, in Zurich. And so we are most fortunate and grateful and an appreciation of Jonathan sharing his time because we're ready to absorb and learn and think. And thank you for being here, Jonathan. Please continue.
It's a pleasure. Thanks. On the sharing, I have prepared some slides. They're just some pictures to support the storyline. Should I do the sharing or I think
You
I
could
can
do
do
the
it.
sharing. I
Maybe it's
think if it
easier. Yeah,
works for you to do the sharing, you can control it a little bit better than we can.
good. Let me try to get the full screen. And I think you see now this hockey stick chart, everyone, right?
Yes.
Very
GDP
nice.
per capita in England.
Yes. So yeah, thanks everyone for participating here. And today I want to talk about one of the most important stories our society tells each other about, yeah, how kind of the world as we know it today is functioning. And this chart summarizes this story, and this chart shows basically the GDP per capita in England. We go back 700-800 years, and we see between 1270 and the 17th century, really nothing is happening, right? It's kind of flatlining, a bit up or down. And then suddenly, around the 17th or the turn of the 18th century, we see this increase and this explosion in GDP per capita, which we can use as a proxy for prosperity. This is when humanity gets prosperous and wealthy. And it's interesting. This is one of the, let's say, phenomenons of our society where we have an almost universal consensus, where we say basically that it is capitalism that enabled this huge explosion in prosperity. And this is even like quite broad across the political spectrum, where people would agree on this statement. Some kind of seeing capitalism as this unequivocal blessing, while others would say, yes, capitalism brought this prosperity, but maybe at social or environmental costs that are unacceptable. But the underlying premise that this is basically the success story of capitalism is nearly universally accepted. And what is also interesting is when we look at the term capitalism, which is a very strange term, but the term capitalism is almost universally defined as well as free market economy and property rights. So you can look at encyclopedias, at definitions. When you look at any modern definition, you will find the term free market economy and the central role of property rights. And those two things are what define capitalism, what we think our economic system is about. This story must be wrong. It cannot be correct. And this chart tells you also why. First of all, we say historically capitalism started around the 18th century, somewhere between 1600 and 1800. And at the same time, so that's the historical definition, but conceptually we say it's about private property rights and about the free market economy. But private property rights, they're around for hundreds or thousands of years longer. And the market economy already, Plato in Greece is talking about how money is used in the market economy and how it enables a division of labor. And for both these concepts, we don't really see any fundamental shifts or changes around that time frame where we see capitalism being basically the new economic system historically. So in other words, the historical and the conceptual definition of capitalism, they don't link up, they don't match. One of them must be wrong. Both of them cannot be correct. And from our perspective, when we wrote this book, Capitalism and the Market Economy, we think the historical definition makes sense. Something changed around the 1700s, around the turn of the 18th century. Something fundamentally changed. But it wasn't about markets or private property rights. And this is what I want to talk about today. Really, what's the story of our economic system? What truly defines our economic system? And what is it about prosperity and stability that we need to know about? And I really want to approach it historically. First of all, it's really much more interesting because by looking at what happened in the past, we really understand why our economic system adapted to the new situation and what it really kind of meant for our economic system that these new concepts were introduced that are central to understand what capitalism is. So let's go back. We're just at the beginning of the 17th century, around the end of the 16th, beginning of the 17th century, and we're in England because this is where capitalism started. It's in the Anglo-Saxon world. And around that time in England, it was just a time when the Spanish Armada was beaten. And for the first time, the global trade opened up for the English kingdom. And trade was possible now with America, but also with Asia. And we called it back then East India and East Asia. And here in this picture, you can see one of the most lucrative trade routes that were around. And this is really bringing spices and other exotic goods from India or from Indonesia, from the Philippines, back to Western Europe. But you can also see it's a very difficult business. It's a very, very risky business. So imagine you're a rich entrepreneur at the turn of the 17th century, and you want to engage in this trade, in this East India trade. First of all, you need to charter not one, preferably more than one ship. You have to fill those ships with a lot of silver. Then you send them on a voyage around the Cape of Good Hope. And then you exchange the silver into trades, into spices. You trade it into spices and you bring the spices back. Now, if you manage to kind of lift this upfront investment, and if the ships indeed make it back to Western Europe, then you will be very, very rich. It's going to be a huge return on your investment. But it's an extremely risky endeavor. I mean, the journey is really long. You can have storms, or the Portuguese or the Dutch ships could seize your cargo. Or your crew could get seasick and or with sickness they couldn't continue the journey. So there's so many things that go wrong that you as a single person or even as a family, even if you're the richest family in England, likely you'll not be able to start this business. And this is when a new concept entered at this time to deal with this problem. And there are two problems with it. The first is really the scale of investment that is required to make this trade work. It's a really big investment. And the second is the enormous risk, how to distribute and diversify those enormous risks inherent to this business. And this is when those businessmen came up with the idea of the corporation. So instead of a family or business undertaking this business, they chartered a corporation. They went to Queen Elizabeth. They asked for a royal incorporation charter, which was granted. And with this charter, they could set up a legal entity that would basically become the legal person who will undertake this business. And with this legal entity, those entrepreneurs were able to walk across London and do a so-called initial public offering to collect the financial resources from many wealthy investors, pool it into one enterprise, and make the journey happen. And this is when the East India Trading Corporation was born. And it became one of the most famous corporations that the world had ever seen. And what we think is that capitalism is about those corporations. This is what made this major change in our economic system and what allowed this new type of business to emerge. This very, on the one side, capital intensive business, and on the other side, um, this much more risky business than, let's say, Mediterranean sea trade or other kind of earlier enterprises. And the thing that really makes this corporation so special is its capacity to transform capital, to pool resources together from private investors and to invest that into ships, into trading routes, even into standing armies, and this financial transformation to make this happen. So capitalism is not about markets, it's not about private property rights. Capitalism is about corporations. This is the first important point here from the story. But there's a second stream that we need to, or a second line or thread in our story that we need to pick up. And this is the thread of banking. And I think also it makes sense. Let's stay into the story, right? We talked about the East India Trading Company that emerged at the beginning of the 17th century. And banking had already existed for longer than that. And to really understand banking, I think it makes sense, even if we're here at the American Monetary Institute, to really walk through again the core mechanisms behind it, because that's really central to understand the economic system and economic order that we have today. And I really like the to historically derive how this banking emerged and also how it connected to trade, to really understand what kind of how it evolved further in our modern economic order. So again, let's keep it simple as an example. And let's imagine now we're around the time 1650. We're somewhere in England, in a small or medium city town, and let's imagine that we're a merchant there. So we would buy those spices that the East India Trading Company imports, and then we would sell it to the consumers living in the town. And let's assume we were quite successful. So we accumulated some wealth by undertaking this business. And in that time, 1650, accumulating wealth means we possess gold and silver coins, because that's what money was at that time, at that place. It was precious metals, it was gold and silver coins. And that kind of brings us into a problem, because if we have gold, silver coins at home, they can get stolen. And to kind of organize security, buy a vault, or even hire people to protect our property is very expensive. So we need to find a better solution. And back then, the solution was to go to the goldsmith of the town, because the goldsmith of the town would not only safeguard your coins, but also the coins of the other merchants and wealthy people of the city, and could afford the security and safety much cheaper than you could do on your own. So you would go to your goldsmith, you would hand over the gold and silver coins to your goldsmith, and the goldsmith would issue you a receipt in return as an evidence that you have deposited your gold with the goldsmith. So far, so good. Now, of course, we continue our business, we continue to trade, and the merchant from the East India Trading Company comes to town and is selling us new pepper from a new shipment that just arrived at the port. And of course, we need to buy this pepper because we want to sell it to our own customers. This is our trade. And we could now go to the goldsmith, hand the receipt over to the goldsmith. Then the goldsmith gives us back the gold coins Then we take the gold coins to the merchant of the East India Trading Company. We hand over the gold coins and then the trade is settled. But it's really cumbersome. So much easier, we just hand over the receipt. And the merchant of the East India Trading Company also has an account with the same goldsmith, and we can settle the transaction right there in an instant. And we already see how the goldsmith perform one of the functions that are essential to banking, these payment services. It's really a virtualization of the gold coins that took place in this instant. And with handing over the receipt, today we will call it a banknote. This transaction could be concluded more efficiently than previously was possible. But here we just have one aspect covered. The more important aspect we need to talk about. Now let's assume we concluded that transaction and a few days later another merchant comes along. This time it's the merchant of the Hudson Bay Company, a company that just set up shop in America at the Hudson Bay, and they have opened up a business for furs. So they're importing furs from the new colonies from America and importing them to England. And the merchant is now here and is ready to sell us these furs. Now, our problem is we just have bought all those spices from the East India trading merchant. So there's no gold coins left. We don't have any money left in the vault of the goldsmith. So we're not able to buy those furs from this Hudson Bay Company merchant. And that's really a pity because we're absolutely convinced that our customers would love those furs and they would pay a really good price for it, and we would almost surely turn out a handsome profit if we had the liquidity to buy those furs. In that situation, we have two options. Option number one is to just accept the fact that we're not able to do this business and move on with our lives, or we go to the goldsmith and see whether we can do something about that. So we go to the goldsmith, we explain the situation to the goldsmith, we tell the goldsmith, give us some money up front, we can pay you back some interest. It's still worth both for us and the goldsmith to do that. And I mean, the goldsmith has a relationship with us for a couple of years now, knows our customer base, and can assess that this business is quite limited in risk because, we just have to bridge the time between buying those furs and selling them on to our customers. So the goldsmith agrees to give us a loan, to give us the gold now so we can buy those furs and then we will pay it back later to the goldsmith. And now it's not like that the goldsmith would now go to the vault and kind of get the gold coins out and then hand it over to us. This is not what the goldsmith would do in such a situation. No, the goldsmith would simply write a receipt and hand it over to us. And we then would the receipt and just hand it over to the Hudson Bay merchant, just as we did before with the East India Trading Company merchant. And now we see really the unique function of banking taking place. We see that the goldsmith, by just writing this receipt, has created money backed on our credit that did not exist before. He created new money. And we then use that money to do commerce, to do trade, and to do business that would have otherwise not been possible. But on the flip side, you can already see what risks emerge because the goldsmith is doing it. Let's imagine we buy the furs, but the furs get stolen, or for some other reasons we cannot sell it on. There is no money or gold coins in the vault backing the receipt that the goldsmith has given us. And if things really turn wrong, then it could happen that other depositors of the goldsmith would try to withdraw their money, and at some point there wouldn't be enough gold coins left to satisfy all those withdrawal requests that could happen, that could hit the goldsmith. So already here we see those two sides of banking, this potential to create business, but also the risk that is inherent in this activity. So let's take stock here. We talked about corporations before. We talked about these new legal entities that allow capital intensive businesses to spring up, to transform assets, to pool the financial resources of many individuals. And we have talked about banking, this technique of creating money out of credit. And now let's combine those two things, the concept of the corporation and the concept of banking. So we're moving on now, another 50 years. We're in the year 1694. And in my opinion, it's maybe the most important year to understand how our economic order, how our modern economic order functions. And it's really vastly underappreciated in our economic history, this watershed moment that happened in 1694. And the watershed moment was the day when the Bank of England was chartered. So the story back then, it was the same story as always. There was a king in England. The king in England was at war with the king in France, as usual. And the king of England had not enough money to fund his war against the king of France. And the newest scheme that they came up with was to create a new banking corporation. So the king would hand out an incorporation charter, which allows wealthy investors in London to create a charter bank. But in return, the king expected that he would get a chunky loan as the first business act of this new Bank of England. And in return, the Bank of England would be the first corporation to conduct the banking business in England. And it was a spectacular success. The corporate form really supercharged the banking business model. When you think about the goldsmith in his town had to be extremely careful on the one side with his business activity and could only expand the money and credit supply very slightly and on very, very safe terms because he was liable with his entire private wealth. He was at risk with everything he owned by his banking business. And on the other side, he had to know all of his customers personally, in person. The personal relationships played a huge role. But the Bank of England was sponsored by the English king. It was backed by the powerful people of London, and it could create vastly more amounts of money and credit than any family or private banking business ever could. And to really understand how different the Bank of England was to its predecessors that didn't have this corporate form, it's really interesting to look at this science of alchemy and how it developed. Before the Bank of England, this alchemy, this attempts to transform base metals like lead into gold was in high demand. It was very actively pursued and was financed by a lot of noble people. But with the Bank of England, alchemy essentially vanished. It ceased to exist. And it's easy to understand why, because the Bank of England solved this alchemy problem. It was legal alchemy that allowed the economy to overcome this scarcity of gold and silver, this scarcity of money, and to flood the economy with money and credit, unlike anything else the world had seen before. And this changed the economic order at that time because this scarcity of gold and silver was always something that held back economic growth and this prosperity that we saw. And for the first time, money was created in much more abundance than before. And I really like this picture. It's somewhere, I'm not sure. I think it's from the later part of the 18th century. And it kind of shows how contemporary people saw this Bank of England. This really, this Midas, this, this transmuting paper and everything into gold and spreading it around across the entire society. It really shows you what this merger between the corporate form and the banking technique had as an impact on our economy and society. But this is just one side of the story. As we saw with the goldsmith before, this business inducing or this commerce facilitating side of the banking business. But there is unfortunately also the other side. As I said, it was 1694 when the Bank of England was chartered. It just took 2 years for the first bank run to take place. There were a couple of things going on. On the one side, of course, the king borrowed heavily and wanted more and more money from the Bank of England. On the other side, there was a recoinage taking place that kind of reduced the amount of coins circulating in the economy. And then there was also a parliamentary debate to charter a second bank, a so-called land bank. And in that situation, the goldsmiths, they saw their opportunity. This is now the moment where the Bank of England is vulnerable. And they organized a bank run on the Bank of England. And it almost turned out to be successful. And if it would have been successful, we would not remember the Bank of England. It would just be one of another failed attempt of the English king to solve his debt and solvency issues. But in that moment, the English government stepped in and allowed the Bank of England to temporarily suspend the conversion of their paper money into gold and silver coins. And that's the way they could quell this escalating bank run. And everyone saw that the rich and the powerful and the king would back this new institution. And it was clear that the Bank of England was here to stay. And that's why in the 18th century, we saw something that did not really happen before. And for that, I think it's really important to understand this what happens when so much money is created that it has macroeconomic consequences, that it impacts the entire economy. This money creation out of credit, this is deeply linked to the financial markets. And I want to quickly explain you how this cycle works. So when you create a lot of money, then this money also arrives on financial markets. Financial markets meaning asset markets, markets for corporate shares, joint stocks, for real estate, for houses, for land, and for other financial assets like bonds. And if more money enters the financial markets, it drives the demand up for all those assets because there's more money around, there's more demand, and that means people will be willing to pay higher prices for financial assets. And this means the prices of stocks, the prices of land, the price of real assets, they will all go up. Now, the lending business side, the credit side of the banking business is tightly linked to those financial assets because those financial assets serve as collateral, as security on loans. So if you get a loan from a bank, very often they will require a mortgage, a collateral, or in a Lombard loan, a financial assets like a share as security to secure the loan they've given. And that means if those asset prices increase, the credit capacity of the financial system increases as well. House prices increase. That means borrowers can borrow more money against their collateral, which they eventually do. But because extending loans means creating new money, this then also means that new money has been created. The overall money supply of the economy has increased as well. And that means that there's more money chasing the same amount of financial assets on the financial markets. And now we have seen that the circle has been closed. More money creation leads to increasing asset prices, and increasing asset prices allow even more money creation. And so a virtuous cycle picks up pace. And we see this already happening in extremis around 20 years after the Bank of England was chartered. It's a really fascinating story about an economist called John Law, a uh, Scottish economist and very illustrious person who fled the British Isles because he killed an enemy in duel, and then when he plays in a when he gambles in some cellar, he meets the regent of France, and then they both kind of discuss and they set up this kind of copy of the Bank of England in France. It's called the Banque Générale. It's later turned into the Banque Royale. And then he also creates a company, this Mississippi company, which issues shares again. And John Law creates exactly this virtuous cycle that I've talked about. So the Banque Royale creates a lot of money, and people use this money to buy the shares of this new Mississippi company. And the Banque Royale accepts then these shares of the Mississippi company as collateral to create even more money. And what we then see is the biggest share price boom that the world had ever seen. It's called the Mississippi bubble. A similar scheme is taking place in England with the South Sea Company and the Swerblade Bank. And those share prices, they increase 20 times within a few months. It's a spectacular boom taking place. But the problem is, it did not last forever. At some point, borrowers have borrowed so much money and have to pay interest on it, then even if they expect that as the prices increase further, even if they expect that, they will not borrow more money because they would have to pay more interest on the borrowed money than they could expect in kind of profits from increasing asset prices. And at that point, what they will do is they will sell their financial assets to repay their loans. But if financial assets are sold, that means there's downward pressure on the financial assets. And if those prices of financial assets decrease, the banks realize that the security and the collateral they have on their loans is worth less. And so they call up their borrowers and ask them to either provide additional collateral or to repay their loans. So the other borrowers, they're also forced to sell their financial assets to repay their loans. And that means asset prices decrease further. So what we then see is the reverse of the virtuous cycle we have seen before. Decreasing asset prices reduce the credit capacity. That means the money supply decreases, and that reduces asset prices even further. Unfortunately, this reverse of the cycle is usually much faster than the boom cycle that it precedes. And at some point, those banks, they are really at risk because the collateral is no longer covering their loans. And at some point, depositors realize that those banks are facing losses because the borrowers are not able to repay. And if that happens, the depositors will run on their bank and pull it out before the bank becomes illiquid and insolvent. And that means this asset price bust turns into a bank run, banking panic, financial crisis. And this is the boom bust cycle I'm talking about. And 1720 is the first time where we see it like really exercised in extremis. And it will not be the only time in the 18th century. 1763, I think that was the Amsterdam crisis. And then 1772 was sparked when the same thing happened again with the Ayr Bank, or the failure of the Ayr Bank in Scotland. So the story is a bit different here. And I want now to go back to a conceptual level. We have covered now a lot of story. We started in the 17th century and we made our way all through the middle of the 18th century. And remember, we talked about very beginning what capitalism is and how it links to the prosperity explosion we have seen. And I would really want to offer an alternative definition and an alternative explanation, which I think provides much more insight and much more light on what we historically see, and which conceptually makes much more sense. So I would define capitalism as an economic order in which most of the capital is managed by corporation. That is the essence and the definition of capitalism. And money, of course, is the most essential form of capital. I mean, capital, that's the means of production, right? And money can be the most, let's say, distilled form of capital. And of course, in a capitalist economy, money is managed and created by corporations as well. So it's really about corporations and corporate banking that define capitalism. And the benefit that capitalism should provide to our economic order is this capital intensity. We saw it in the East India Trading Company, enabling these really much more scaled capital intensive businesses. And then also the money creation by the Bank of England, flooding the economic order with much more money than existed before. And this is really this capitalism linkage to the Industrial Revolution. I mean, it was about factories, about infrastructure, about canals, about railroads. This is what we associate with this era of capitalism on the real economy side. And this is basically what was brought in by this corporation and by corporate bank. And by defining capitalism this way, it doesn't mean that the market economy is irrelevant. It's an addition to the economic order. The market economy was already there before. The concept of markets, the concept of a decentralized exchange where property rights are voluntarily exchanged against money on a marketplace without central coordination. And it's this market economy that allows the specialization and the division of labor that enables competition and innovation. So the story about this hockey stick curve was we had a market economy and then we added this capitalism to it. And this is where it seems that the prosperity curve has kicked off. Let's tentatively think about our economic history in this way and about what capitalism is. And I think now there are some important questions that come up because when we think about how to organize our economic order in this naive way that we have been doing for the last 300 years, and we just focus on the market economy, then we didn't really came up with very good ideas on how to organize our economic order. And for that, I want to go back now into the historical thread. And we're now 4 years after the financial crisis triggered by the air bank. And this gentleman published a very famous book in economics, which is called The Wealth of Nations. And the economist here is Adam Smith. One of the most famous economists. And he's considered basically as the founding father of modern economics. And he's really famous about what he wrote about the market economy. So he talked a lot about the market economy, and he used this visualization or this analogy of the invisible hand, kind of explaining that the market economy, although it's decentralized, although there's no central management and coordination through those mechanisms of supply, demand, and prices, and the division of labor, it will nonetheless foster general welfare and prosperity if markets are free and if markets are not interfered with by central authority. So just if we implement robust property rights, and then if we let free competition reign, then we will achieve more prosperity. That's the part of Adam Smith that is very famous. But we just talked before about this is just half of our economic order that we talked about. So what did Adam Smith talk about the other side, about capitalism? And if we define capitalism in this more meaningful sense, then I think it is fair to say that Adam Smith was a staunch anti-capitalist. He was absolutely against corporations. And it's not so hard to understand why, because think about the most important corporation at the time, that was the East India Trading Company, that gained a monopoly on the entire trade with the East Indies. And monopolies don't fit with Adam Smith's idea of free markets. So clearly there was already a conflict with his ideas. The second thing was that the East India Trading Company, they had standing armies, they waged war, they occupied territory. And Adam Smith was of the opinion that wars were not good for prosperity, a very obvious and valid point. So he was more a pacifist. So that was another reason why he really disliked the East India Trading Corporation. But his point went even more fundamentally. He really thought in a corporation, the ownership of the corporation and the control, the management is separated. So that creates a conflict of interest. So why would the manager of a corporation be interested in that the business is successful? I mean, they don't have their own skin in the game. They don't own the corporation. The corporation is owned by passive investors who don't do anything for the success of the corporation. So for Adam Smith, it was completely clear that corporation would never, ever succeed in the real economy because they would be squeezed out by private businesses and by family businesses who would have their skin in the game and would outcompete those corporations easily. Yeah, we could say he was quite wrong about that. Corporations have conquered the world and they completely and absolutely dominate all aspects of our economic order today. But what did Adam Smith thought about corporate banking? And here, interestingly, everything is reversed. He hailed the Bank of England as the great engine of the state. He thought the Bank of England was one of the best institutions that existed, and he defended it against critics. He was a huge fan of the Bank of England. And when you think about it, the Bank of England was a corporation, which Adam Smith hated. It had a monopoly on certain aspects of money creation, which goes against the ideals of Adam Smith. One of the scholars wrote about it, that the Bank of England, if it did not exist, it should have been made up by Adam Smith as an example for everything that is wrong about the economic order of England. So superficially, it really seems this doesn't make any sense. But I think he was more right about that aspect than about corporations in the real economy. For Adam Smith, it was completely clear that money and credit and finance are aspects that have nothing to do with the market economy. There's no way that we can leave the money and banking business to the free market forces. The whole concept of the invisible hand simply doesn't apply there. And it's obvious. We saw it in the boom-bust cycle with the Mississippi Company. Just 4 years before he published his book, there was a severe banking and financial crisis that had global repercussions and led to unemployment, to poverty, to famine. And for him, it was completely clear. You cannot leave that to the market forces. You need to regulate it. You need to control it. You need to make sure that the government backs it up. So, because there is no way you can rely on the invisible hand that money and banking would work in our order. And as I say, he was partly right. So he was wrong about what corporations do in the real economy. He thought they would not have a chance of survival. He was wrong about that. But what he said about corporations acting in the financial system, where it's about money and banking, he was completely right about that. And conceptually, I want to draw it up how our economic real order works and how it is set up to function. And let's just keep it really simple, because simple is always best. Think about this two circle. This is our economic order. At the center, we have the financial system, and around our financial system, we have built our real economy. Now let's add capitalism to our economic order. Capitalism is everywhere. It's in the real economy, it's in the financial system. We have corporations in the real economy organizing the capital, and we have bank corporations creating our money. Very simple. Now let's add the market economy to our economic order. We have in the real economy corporations competing on the marketplace, which is fine. But at the center of our economic order in the financial system, we cannot use the market economy to organize it. It simply doesn't apply. So that's why we have highlighted it here in red. It's not organized according to the principles of the market economy. This is basically when you condense Adam Smith's work and account for his mistake he did about corporations acting in the real world, then this is basically how our economic order is actually set up. And this is also a setup that was propagated by basically all, it's an overwhelming consensus that will not change over the next 300 years across all economists that basically seriously debate on how our economic order is set up. Or let's say not like that, but all the mainstream dominant viewpoints of economics. They all agree on this fact. And if the financial system is not organized according to the market forces, so how it is organized instead, we can characterize it as a carrot and stick approach. So on the one side, we have to do something against the bust, the bank run, and the financial crisis. And for that, we have guarantees. We have central banking that was set up already in the Mississippi crisis in 1720. There is kind of some indications that the Bank of England acted as a lender of last resort to somehow cushion the fall. And this was then later instituted by a kind of economists like Barings, very famous, of course. What's his name again? This economist writer from the 19th century, Bagehot, who brought this kind of lender of last resort principle in. And this role continuously evolved. The Bank of England even started as a regular banking corporation and somehow evolved into this role of central banking to backstop the financial system. Those guarantees were only extended over time. In the 20th century, deposit insurance was added, and towards the end of the 20th century, we went into a too big to fail doctrine, which essentially resulted in an unlimited guarantee for all the liabilities of all the banking corporations. But of course, you cannot just control the bust, the crisis, and the panic. You also need to do something against the booms that preceded. And these are the constraints. We want to prevent banking corporations to go wild and crazy in their money creation. We have to restrict the growth and their money creation. And that's why we have capital requirements, liquidity requirements, and all sorts of business restrictions implemented. And the goal is really this boom-bust cycle to iron it out, to dampen the boom, to protect it from the bust, and somehow do what the invisible hand is unable to do, to somehow equilibrate the financial system, make it work for the economic order. So how well did that go? So every red number you see here on the timeline is another boom bust cycle turning out. The 19th century is staggering full with booms, busts, financial crisis, bank runs, etc. We never got a handle on it. We never got a handle on the boom bust cycle. I think the historical evidence is overwhelmingly clear on that. And we see now also an increasing severity of those financial crises when we look at the timeline where we see like the Great Depression at the beginning of the 20th century with huge global implications. Again, I want to quickly take stock here and go back to the very first slide I've shown. And I mean, you can see here a bit the implication of all those red annual letters or annual years that we've seen before. And you could argue, well, yeah, it's capitalism. Capitalism is boom bust cycle. This red thing in the middle, we just don't have it under control. It's like an engine that produces a lot of heat and energy, but explodes every once in a while. But still, look at the overall result. I mean, yeah, it's a few years it goes down, but the overall trend is upwards. So maybe the storyline could be, yeah, we buy this prosperity and that's just the price we have to pay. And I think this is, let's say, the more honest argument about the benefit of capitalism, right? Why capitalism ought to be a good thing. And this brings me basically then to the second part. I don't think it's true. I think the prosperity, the trend in prosperity that we have seen over the past 300 years, it will not continue in the current economic order. I don't think that this economic order that has brought us where we are today will bring us any further in prosperity. I even think maybe it's going to stagnate, or more likely, it's going to go down again. This economic order will not be able to bring us more prosperity from the point we are today. And I think it will continue to bring us those boom bust cycles as it has done in the past. And I want to explain you why I think this is the case. Interestingly, after the Great Depression, we could call it the Great Calm, there was a historically unprecedented period of absence of financial crisis up to the 1970s. But then in the 1970s, things changed. And I've collated some graphs from a homepage actually, which is called, what happened in the 1970s.com. And I picked some of them that this homepage collected because I really think they show how the story of capitalism shifts dramatically in the second half of the 20th century. What you see here is asset prices, and I proxy these asset prices by real house price in Amsterdam, but I think it is, it is representative for house prices all around the world and asset prices all around the world. We see a very interesting stability for 300 years, and then in the 70s, an explosion in asset prices. The same is true for consumer prices, which I also think is very interesting, where we see in the wars, the Napoleonic Wars or other wars, we see some blips, but we see a remarkable stability of consumer prices. But then in the 70s, we see consumer prices exploding to this day. Financial crisis, there the story is basically a gradual increase over time. We see more and more severe banking and financial crisis as the history of capitalism moves on, with this really interesting, very silent phase between the Great Depression and the 1970s. But you see this great calm is very over. So we are living in the most financial unstable times in the history of capitalism. And you can see that's also in the volatility of asset prices, in the number of banking crises, in the number of currency crises. This is all on a much higher level than it ever was in earlier periods of capitalism. And also on the size of the financial system, the level of money and credit created. I mean, this is not a logarithmic scale. That's why it really looks like a skyscraper. And it's also a proxy for all amounts of financial assets and financial debt created. We see this huge explosion. in the 1970s in the amount of debt/assets, the financialization of our economic order. And I think there are two factors that really changed in the 1970s. The one is really the move, the complete detachment of the monetary system from gold and silver. So we adopted a pure fiat monetary system. But even more importantly, it was the digital revolution. And yeah, I'm grateful, Stephen. You mentioned it in the introduction, right? And I think what really happened is that the money creation by non-traditional banks really took off in the 70s. When you imagine it before computers existed, the banking business was really a pen and paper based business. You had one huge book in the bank where every transaction and every balance was recorded. So the whole business was simple and contained to one traditional bank balance sheet. But with the digital revolution, you could slice, dice, and redistribute money and credit across jurisdiction and balance sheets. And you could basically create money and credit in completely new ways on corporate balance sheets that did not belong to the traditional banks. And I kind of conceptually show that now. We go back to this overall pictures, right? On the one side, this expansion of the financial system itself, the financialization that really becomes bigger and bigger at the core. But that also means that the market economy is squeezed out of our economic order. But even more problematic is that the boundaries between the bank corporation and the corporation supposedly acting in the real and in the market economy, that this boundary has broken down. The rise of shadow banking means that money creation is now taking place in every corner of our economic order. This differentiation between what is banking and what is not banking, what is financial system, what is the real economy, has broken down. And because the market, because we organize the financial system not according to the market economy, but the rest of our real economy we do, this creates huge problems. It means basically that the market economy has to be squeezed out further. We cannot let the market economy runs its course, because when we see insolvencies and liquidity issues, then we have such huge amount of systemic risk, such crazy busts and financial crisis and financial panics occurring, that the whole economic order would instantly collapse. And it also means that those corporations which act in the real economy, we can no longer let them organize, let them kind of run in a market economy. And the core argument is this: if we keep our economic order as we have kept it in the last 300 years, it will mean that we have to remove the market economy from our economic order. We cannot keep the market economy. And I think Adam Smith was right in his assessment that the market economy brings prosperity, because it brings this competition, brings this innovation, this dynamics. Of course, it's not perfect, and you need a lot of guardrails for it, competition law, environmental protection. But the market economy is a crucial part of the prosperity puzzle. It has always been. And if we get rid of the market economy, I don't believe that our economic order will be able to continue to provide prosperity. That's point number one. And maybe even more importantly is that the market economy is one of the underpinnings of a free society. It's like democracy, free elections, or the rule of law. And it's kind of the materialistic justification for freedom. Because if you think about reversely about what Adam Smith says, yeah, if we let everyone do decisions for their own, the society as a whole can still be better off. If you kind of negate this point and say, like, if we let the market economy run, we have this chaos and this crisis, that also means you have no longer a justification for freedom. You need to remove freedom from society. So our economic order is not only failing us to deliver more prosperity, and it will fail us to deliver more prosperity, it will also fail us to defend our freedom that we have enjoyed through large parts of the 20th century and the beginning of the 21st century. But this fate is not inevitable. Capitalism is it's a legal creature. It has been created by our laws. It has nothing natural in it. So we can design it in any way we want to have capitalism defined or designed. And I believe that we can design it in a way that it will create an economic order that is continue able to bring us more prosperity, and that will even no longer have this inherent flaw of the boom bust economy. And the problem is really to draw the boundaries between the areas where we can apply market principles versus the areas in our economic order where we cannot apply market principles. And we believe we have found an instrument that allows us a clear boundary between the parts of our economic order where market principles apply versus the corporations that cannot be operating according to market principles. And we call this rule, we call it the systemic solvency rule. It's a very simple rule. For every corporation, the value of the real assets has to be greater than the value of the liabilities. That's at the core, the systemic solvency. There is a general version of it, which kind of includes derivatives, but in essence, it's still the same. And maybe I don't want to go into too much details because we could spend another 45 minutes really explaining it and going through the balance sheets. But think about every corporation as a domino stone. Now, the systemic solvency rule now prescribes minimum distances between all those domino stones. Now, if a corporation becomes insolvent or has to be has to go into bankruptcy, that means the domino stone will fall. And the systemic solvency rule itself ensures that it will not take any other corporation with it. So it's kind of, it prevents any financial chain reaction. That's the idea of systemic solvency. And it has to apply to every corporation that is in our economic order. It's not kind of, it doesn't matter whether a corporation calls itself bank or non-bank or whatever. Every corporation needs to be subject to systemic solvency. So we then propose to implement systemic solvency in our entire economic order. And then we give some transition periods, say 10 years. And after 10 years, we take stock and we make a distinction. We put all the corporations that are systemically solvent and we put them into the blue part of the circle. They are systemically solvent. They are able to be organized according to the principles of the market economy. As long as they're systemically solvent, they are aligned with the market economy and they can coexist in the market economy. But there will be corporations, banks and shadow banks, money creation banks that will not be able to reach systemic solvency. And we call them systemically insolvent corporations. And systemically insolvent corporations cannot be aligned to the principles of the market economy. They stand outside of the market economy and they need to be regulated as such. And we continue this regulatory framework that we know that already Adam Smith implemented. So on the one side, we will say all the liabilities of all the systemically insolvent corporations are explicitly guaranteed 100% by the government. I mean, we do it anyway today. We always and at any time, in any situation, fully guarantee all the liabilities of any financial institution that poses systemic risk. But let's make it explicit. Let's end this charade that we say, oh, in the next financial crisis, we will have some resolution regime or market or whatever. This is all bullshit. We all know it. Let's just make it explicit. 100% guarantee on all the liabilities on all systemically insolvent corporations. But that also means that we will implement constraints that actually work. We will implement capital requirements that are effective, let's say 20, 30%, the likes like Anna Datmati proposed. We will have very tight liquidity requirements. We will have regulatory frameworks around what business that those systemically insolvent corporations can do. And it will also no longer be able for those, will no longer be possible for those systemically insolvent corporations to circumvent it via the shadow banking, because this is exactly the purpose of the systemic solvency rule, that will no longer draw the boundaries according to the self-labeling of the corporation, but really effectively the balance sheet structure of the corporation. And this way we can contain and draw a clear line again in our economic order. And this will enable us at least to restore a situation that is similar in its stability and its kind of operating effectiveness as we had it at the beginning of the 20th century. But I think more is possible. Once we have stabilized the situation, I believe that we can build a world without banking. I really believe that we have to set up a financial sector that is systemically solvent. We have a lot of financial technology, like we always had mutual funds, for example, equity markets, bond markets that can operate in a systemically solvent fashion. We have new technologies like peer-to-peer lending, where we can pool resources from many households and directly lend money to enterprises, to big ventures. And there's even new blockchain technology that also carries the promise of this decentralized finance, systemically solvent finance in it. And what we need to enable is that those systemically solvent financial corporations will have the same access to to the central banking, to the payment system. This goes into the direction of CBDC as the systemically insolvent sector. And what is also important is that the systemically insolvent financial sector is not subsidized with those guarantees. So we need to make sure that they pay a fair price for the systemic risk that they create, and that we create a fair competition between the systemically solvent and the systemically insolvent financial sector. And I am absolutely convinced that if they compete on equal footing, that the old banks will disappear very soon. And what we then will see is basically an economic order where capitalism and the market economy becomes fully aligned, and where we not only have market principles operating in the real economy, but also at the core of our economic order, where you have true and decentralized markets at the financial system level as well. And what I also believe is that such an economic order will be even more able to create prosperity and will no longer feature those boom and bust cycles that we have seen throughout the last 300 years. And this is where I come to the end of the presentation. And maybe as a final remark, I really think it's all about prosperity. And when I talk about prosperity, it's not, the GDP per capita is a proxy, and it's a bad proxy in many levels. But when I talk about prosperity, what I really mean is the capability of our economy to do what we want to achieve as a society. And I think a lot of the prosperity that we have created over the last 200-300 years, we were always forced by financial stability consideration to just have growth at all costs, right? And to create more consumer goods we maybe don't need, or where we create growth at unacceptable costs for our society or our environment, just because we were forced, or one of that was we were forced by financial stability considerations to do so. And if on the one side we really supercharge our economic order, that it becomes much more capable to create prosperity, but at the same time reduce this inherent instability and fragility and weakness in our economic order, we can really create much higher quality prosperity than in the last 300 years, and have an economic order that will achieve much more from society, for our society going forward. That's basically the vision that we have with the work we do and the proposals that we have developed in our newest book. Yes, thanks very much for your attention.
I was muted myself. Thank you, Jonathan, very, very much. That was a very clear point that we can build on. It reminds me of your books. They're very clear, definitions very clear, and the presentation too, very clear. And it gives us a foundation to think upon. And it's a clear foundation you've presented. And there's different types of thoughts and questions for the few minutes the 15 minutes or so we have left. And that is, I'll give two little questions. They're very general. I can open it up. And also then I have some leftover questions that I've gone through and have reworked a little bit. But I'll give these two obvious questions, I think, right from our talk today. And then I'll open it up to people. And if we have any little time, I'll grab a question back from the reading circle earlier in the summer. So the first question I have is, then you just talked about this transition happening, and if there's equal competition, that they're forced towards equal competition, then we can put all of the banks into the blue circle. Everything becomes solvent at that point. And you mentioned the idea of a 10-year transition. Is this 10-year a transition towards your final goal of achieving total solvency, or might it take more than 10 years or less than 10 years? Any thoughts on that?
I think it will take more than 10 years. The 10 years is really when basically the entire regulatory framework has to be set up according to this new logic. Where, basically systemic solvency becomes part and parcel of any financial reporting for every corporation. But I think, of course, because when you set those 10-year threshold, I mean, it will adapt the behavior and expectation of people from today on, right? So it will already spark this systemically solvent financial sector immediately. I'm convinced about that because there is a first mover advantage, right? Of going there. And the final transition, I think, I don't think it will take more than really a very low number of decades. I don't know, maybe 1, 2, 3 decades. And then it will lead to the disappearance of the banking sector. That's what I believe. But I mean, of course, I don't have any, let's say, scientific or let's say falsifiable evidence to kind of underscore this belief.
Okay, so we could say up to possibly 30 years, and the word possibly is in there. Could take
1 to 2 generations, yeah.
Yeah, it could take some time. Okay, and so when you talk about the fintech banks in your book, that might be doable in the first 10 years to help set things up. One of the questions that comes up is that the old banking system, if you give them a little bit, they'll keep taking more. And also we may lose our vigilance to keep working towards solvency. And one of our strong feelings is to get towards total solvency is education. We have to really educate. And one of the things you said in your first book, you explain what needs to be done. And the difference between your first book and your second book is that this book actually becomes political. And in that sense, there needs to be education and awareness and a willingness to move politically among all common people to achieving this solvency. And we can't lose the focus of it, because as soon as we lose the focus of it, the process of insolvency may end up reversing and growing again in banking corporations. Any thoughts about that?
I fully agree on all that you have said. And maybe in earlier versions of the book, after a 10-year transition period, we kind of had this bail-in idea, right? That after 10 years, yeah, we take those resolution regimes seriously, and we say like after that time, everything has to get bailed in, right? And on one side, you could say maybe that's politically more realistic because you make a cut and you say like, yeah, there's a dramatic shift at that point. But really technically it becomes an absolute nightmare because no one would know what would happen right today when such a plan is credibly announced, right? Because you would credibly announce today that in 10 years' time, bail-in mechanisms would start. This could potentially lead to a huge financial crisis, like immediately on the day of the announcement, right? So maybe that would have been politically like more feasible and maybe more attractive because it's like, yeah, you have a bail-in, you have a almost revolutionary change of the system, right? But it, yeah, anything could happen, right? No one would know what would happen in that way. The way we propose is technically absolutely feasible. But as you say, Stephen, um, it requires enormous political willpower, and it requires enormous political willpower over extended time periods, and it requires enormous political willpower against very powerful interests. And I'm not an expert on that, and I see absolutely those issues here, right? But I don't see any other way. That's my problem. I just don't see any other way than that one.
Yeah,
Um,
yeah. We're playing with all of this too. And 20 years ago, Jonathan, we were not at this. When Zarlenga, we began our first conference 20 years ago, and there were very few people aware. And we were aware. We ended up proposing two bills in the US Congress to change the banking system in a solvent to create solvency. And it does it very similar. It's called the Need Act, and it creates solvency. It more immediately, but it's very similar, and it's supportive of the banks afterwards by giving them the ability to get money through this revolving fund as further loans are paid back. The banks have some guaranteed access to those monies, and there's like a transition period in there, if you will, too. So we're very similar in some ways in terms of monetary reform. Um, but in terms of the political and educational awareness and for the voters, we have to do a really big wake-up call. And so we're thinking about that. And people are bringing up all sorts of issues of change, of not only in the money and the banking system in the narrowest way, but in this larger political economy we're in with other aspects going on. So, but at the crux of it is is the monetary system and everything you discussed this morning, and we've been keenly aware of it. And you bring in a new perspective with solvency because our thinking was limited to seniorage before. So I would like to stop and open up the questions. So maybe I'm going to like remove, if I could, I'm going to stop sharing on your side, and us both are here. We got a number of questions. Howard, go ahead. And let's make them quick. We've already got 4, and we only got
Thank you,
about.
Jonathan. I appreciate your presentation. I really like that solvency rule. But I think that it's public policy, and the financial corporations control public policy. So you're right. It's going to take a political movement to make that change. And how do we sell the change to the electorate? Because that's who we need to educate about all of this. And but thank you very much for your efforts.
Thanks.
Okay, um, Patrick, if you can not, let's see what you'll do. Or okay, Nick. Nick might have been first. Sorry. Go ahead, Nick.
Actually, Patrick was first, but I'll go. I have two big concerns. And it was a wonderful presentation. I mean, really a wonderful presentation in history of what we've got right now. And I thank you for that. The first concern is the system that we are talking about is the system that has such great power to keep any other thought out of the discussion at all, such as your systemic solvency, that you and your co-author felt the need to write your books anonymously, and you're not the only one. Economists are afraid to speak up against this system, and that's absolutely horrible. That's absolutely horrible. Now, to get down to the nitty gritty, monetary reform, what we're talking about is changing our money system so that it's a publicly sovereign system created by the government and publicly created, and stop the bank creation of money. So we could do that overnight. The Need Act was put into Congress in 2012, and there have been a couple of things that the Alliance for Just Money has come up with, the American Monetary Reform Act of 2024, which would update the Need Act. And what you're right on, you're on point with the feelings of 95% of us, as far as we have to change the system. It's a horrible system. We can't put the environment first, for example, in the system. I'm going to just see if you can answer what I've asked, so I'll shut up.
Or any thoughts there may be,
Yes, and maybe, I mean, and it was intentional. You realize I haven't really talked a lot about money itself, right? I mean, the main topic was corporations, corporate banking, and like monetary policy, let's say, like where outside money is coming from and how outside money is created. Neither on the problem side nor on the solution side, I really talked about it. And this was very intentional. I would bring 2 points up to it. And maybe my more fundamental point is, and that's my personal belief, I think this fundamental question about capitalism is more important than the question about how monetary policy should actually be designed. I would go even one step further and say, as long as we don't fix the corporate form and reform capitalism, any monetary policy choices are irrelevant. They just don't matter, because financial stability consideration will always eliminate any other monetary policy choices that are kind of like all ex ante choices on monetary policy will eventually be superseded by financial stability concerns. For example, in the Eurozone, we see that like there was a monetary union set up with the only goal of price stability, even kind of not having any fiscal union, and those kind of objectives couldn't be like they couldn't be pursued. They had to be put in second line behind financial stability concerns. So, and given from my opinion that this is the most important question, I have less let's say we also provide our idea how monetary policy then could be designed in this new kind of systemically solvent capitalist system, right? We bring this idea with the unconditional income and the liquidity fee to kind of bring it in and remove it. But there are also other ways, and we describe them. And I don't think for us, there are two separate questions, right? One, reforming capitalism, fixing capitalism, and then redesigning money, redesigning monetary policy. I really cannot stress this more enough, or I really think it's really important. They're two separate questions. And in my opinion, if you don't resolve the capitalism question, anything you do on the monetary policy side is irrelevant. As a point in case, and we have the CBDC discussion often, let's assume we just now introduce this new monetary policy in the current system, right? And we don't change those problems, or we don't address those problems with the corporate form I've discussed. Maybe you would have CBDC. You could maybe kind of bring in more competition on the payment, on payment services, or with this newly injected money, maybe you could kind of push some investments and push the economy more into the direction where you have your social goals or your environmental goals. I mean, this is all feasible, but eventually financial stability concerns will come back and bite you. You will be then forced to bail out, to guarantee the liabilities, to make sure that financial markets and asset prices stay high enough that you don't have this bust cycle turning into a financial panic. And that will then become again absolutely dominant in our economic order.
Thank you very much. We're 1 minute over right now, Jonathan, and I'm thinking your time. I know you have family commitments too.
I have a few more minutes. It's fine.
Okay, Patrick, let's.
Jonathan, your discussion is music to my ears, and I couldn't agree more with your entire model. The question I have is, are you now required to go further to understand the nature of corporate capitalism and tell a different story? Because the story you told can only be said to be historically incomplete, and because it's so incomplete, untrue. And the three examples I want to tell you that I would love your reaction to is that the Royal African Company was a royally chartered company that traded in 4.2 million slaves, and much of the value that created the modern banking system came from slave labor. That's point one. Point two, the British East India Company ran corporate armies and fully integrated with the state, 100,000 mercenaries hired to go slaughter people. That violence and imperialist control to extract wealth is nowhere in your account. Third, mainstream people like Mirza Badarian, who was nominated as comptroller of the currency by President Joe Biden, has written The Quiet Coup and said that corporate capitalism is about chartering a corporation that externalizes losses and gets subsidies for those losses as part of an extraction regime that was like Jamestown and the Hudson Bay Company, fully integrated private governments, and that's nowhere in your account. So she ends with saying we have to liberate markets just as you did. She said that the corporate state, the corporate entity chartered by the state, integrated with the state, has to be reformed. And you treat the corporation as autonomous from the state. And as I think Clara Mattei will show today at 3 in Capital Order, and as Stephen Maher will show at 4 in Rise and Fall of American Finance, as he did in his book on General Dynamics, your account is not just historically untrue. It takes the history of the corporate state and flips it to treat the corporations as autonomous. So my question is, could you give the next lecture with me agreeing with every single thing you said, and then fill in a better account of the corporate state and reform corporations as the only way that your vision becomes anything other than utopian? That's my question.
That's a big one, Patrick.
Yeah, that's a very. It's a nice one, yeah.
It's deeply concerned about everything in capitalism in terms of its historical political power and poor effects in the world. a quick thought, or we can move on.
Let Jonathan reply a moment.
Yeah, I need a moment to reply. Yeah. So, I mean, maybe on the writing itself, and I mean, we're very kind of, let's say, we were very solution oriented. So we really provided a basis what we needed to explain our reform proposals. And I think it's very interesting what you said, and let's say the origin of corporations or the origin of capitalism, right? And I think the East India Trading Company is a fair representation of the origins of capitalism. It has been a creature of the state. Not only that, it is really kind of the rich and powerful kind of created this as an entity that was designed to take over almost state centralized government military functions to further, let's say, the interests of the sovereign, of the king, to exploit trade other nations. And the East India Trading Company became like an entity that had had a lot of similarity to, like, let's say, a state, right? They had a standing army. They even kind of had governors that had a lot of political power, and it really shows you that capitalism is a centralized, is a top-down concept. It's a concept that is about projecting power, right? And it's really about centralized power. And I think we write it quite clearly in the conclusion, where we talk about this effect that when we keep the economic order this way, that the market economy will go away, because the market economy is the other side. It's decentralization, ideally competition, keeping political and economic power in check. Although, of course, we have the weaknesses with monopolies or cartels or other kind of obstacles to competition. So we're very clear about that, and we're also very aware about that the corporation is a let's say a concept of the powerful. And I think one idea that kind of also clarifies that is, if we continue on the trajectory we're at, capitalism goes back to its roots. So, I mean, the early capitalism, like the East India Trading Company, was capitalism without the market economy. It was about giving a trading monopoly, give East India Trading Company the right to attack every ship that was trading on their route, right, and seizing the cargo without asking any questions. And what we see, for example, those economic systems of China and the USA came from a more market-oriented, freedom-oriented side, but after so many financial crises now, really this corporate world becoming like completely detached from the market economy and staying above the laws, right, or let's say the principles of the economic order. And China, from the other side, coming from a pure state system, then spawning those corporations directly next to the state. And what we see basically is really how those concepts now end up at the same place, right? That let's say the Chinese economic order and the US economic order becoming a pure capitalist non-market economic order. I think the point that you're raising is exactly the worry that we're formulating at the end here, right? We squeeze out the market economy from the economic order, and all what we have left are powerful corporations that are no longer in check by anything, right? That wield their power without any checks and balances. Yeah, that's what's going to happen.
I'm going to give John the last question, and then we'll end, but we'll also continue this with our next speaker in a little bit, Samuel, from who you know from the reading circle too, and he'll speak on his ideas about central banking, and we'll continue central banking and banking system conversation. John, go ahead.
Well, thank you so much, Jonathan. It was a brilliant historical analysis, and you've made an enormous contribution to our thinking about this whole thing. I guess I wanted to ask one question that you've already, I think, answered. I wanted to know what you thought of the Vollgeld initiative in Switzerland that was done several years ago. But I want to say that my concern about what you're talking about here is that basically you're going to let you're going to go to sovereign money, but you're going to also let these non-solvent corporations continue to function in this transition period. And you're going to depend then on regulation to essentially bring them in, to limit them, to constrain them from the kind of things they've done in the past. But Omarova has described so clearly that technology has made this impossible, this kind of regulatory, and your own book shows the difficulty of regulation of this. So I'm worried about the feasibility of this interim transition period in which you let non-solvent corporations continue to create money, which is the power that they have, and expect that regulation, which has not worked in all these decades, is now going to work. So that's my concern.
You got it out, Don. Thank you very much. Good question. Jonathan, your thought?
I think your concern is valid on the political economy side, yeah. And I think I stated that before, right? I mean, the only other alternative is, as you say, yeah, the bail-in. And I think the catastrophic risk is too high. And I also think the support that you could get publicly, therefore, is too low. You will not find any politician or really influential group that would kind of seemingly take this risk. I mean, we're really talking about the cardiovascular system of our economic order and the total breakdown of it, risking it. Yeah, maybe it will anyway end up there, and then we can start on a clean slate again. Yeah, but really willingly risk it. I really think technically there is an option out of that without like really blood and tears, where we can gradually reform out of it. And this was the goal. We wanted to show it. And you're right, from a political side, this is very vulnerable. There's no question about that. I want to kind of the technical thing there. The problem is not anymore this technology, this circumvention, right? And we describe it very clear or very detailed in the book, in the new one, but also in the old. It's really this boundary problem, right? It's really this stupidity of only regulating corporations that put the label bank on their name or on their charter or whatever. That's really incredibly stupid, right? You have to look at the corporation and then you have to analyze, does it create systemic risk? And if that's the case, then you need to regulate it. So all the ways of shadow banking and all the ways today what banks use to circumvent those constraints, they're all addressed with the systemic solvency. I haven't, and we're discussing that for 10 years now. No one has came up with a kind of a technically feasible way to circumvent systemic solvency. I don't think it exists. And maybe, and I think that gets broader than just the answer to your question, John. But let's say formulating a proposal that can have broad-based support, like in a wider society, from people who have not a minute's time to think about monetary question, which includes 80% of the people. And it's not because they don't understand, because they have so many other problems they need to deal in their life. I think the central argument of everything must be prosperity and fairness. The current economic order is not only unfair, everyone sees it's unfair. But I think the biggest lie that is told about our economic order is at least it gives us prosperity. And I think this is the key point. Like people who talk about monetary reform, they always talk about financial stability, bank run, crisis, etc., blah, blah. In a fiat monetary system with unlimited and unconditional intervention in any attempt is financially fully stable. There cannot be ever an instance where you have financial instability because you always pump money wherever it is missing. The problem is prosperity. This economic order will no longer create prosperity. People will be poor, people will no longer be healthy, people will die earlier. It's just a shitty economic order that is not able to provide prosperity. And that must be the central argument of any monetary reform proposal. Everything else is doomed to fail. That's my opinion.
Thank you.
Thank you very much for a straightforward, powerful reflection